The money in your bank account isn't actually there. This isn't a metaphor, and it's definitely not a conspiracy theory. If tomorrow every customer walked into their bank and demanded their cash, the system would collapse within hours, because that money does not physically exist. This isn't a bug or a malfunction. This is the global financial system, a trick so old and so deeply rooted that we've come to see it as normal. It's called fractional banking, and it is the silent engine behind global debt, inflation, and the illusion of wealth. Once you understand how it works, you'll see. Money is built on promises that can never be fully redeemed. To understand how this began, we have to go back long before apps and digital screens. In medieval Europe, money meant gold and silver. If you were wealthy, you had a chest of coins or jewelry you could trade, but carrying bags of gold was dangerous. So people began storing their valuables with goldsmiths, the people who had secure vaults. In return, the goldsmith would give a receipt, a note promising that the gold would be returned when claimed. People soon noticed something interesting. They could trade the receipts instead of the actual gold. After all, the receipt represented the same value and was much easier to carry. This is where the trick was born. Goldsmiths realized something. No one ever showed up all at once demanding their gold. If they had 100 customers, only 1 or 2 would come on any given day. The bulk of the gold just sat there untouched. Goldsmiths were clever men. They started issuing more receipts than the gold they actually held. If they had 1,000 coins, they might issue 2,000 receipts. They could lend out those extra receipts at interest, earning money on gold that didn't exist. As long as people didn't demand their gold at the same time, nobody noticed. It was essentially creating money out of thin air. And this wasn't some small side hustle. It was revolutionary. Once people accepted paper claims as equivalent to gold, money creation became completely detached from physical reality. Banks were born from this practice. They institutionalized the trick. By the 17th century, even governments embraced it. In 1694, the Bank of England was founded, not to serve the public, but to solve a problem. The Crown was drowning in endless war debts. The bank lent the government far more money than it actually had, collecting interest in return. These debts weren't paid with treasure from conquests, but with taxes collected from ordinary English citizens. Sound familiar? Because today, governments do the same thing. Borrow money that doesn't exist, and force future generations to pay it back. America followed the same path. Early US banks issued banknotes redeemable in gold, but soon they too realized they could print far more notes than the gold they held. Occasionally, bank runs exposed the truth. Crowds demanded their money, but the money wasn't actually there. Banks could collapse overnight. And once again, instead of dismantling the system, governments reinforced it. Central banks were created to support the illusion. The message was clear. Even if the money isn't really there, we'll make sure people believe it is. Now let's explain this in modern terms, because fractional banking can seem abstract. Let's say you deposit $100 into a bank. You assume it sits safely in your account. In reality, the bank only has to keep a small fraction of it. It used to be around 10%. The bank would keep $10 and loan out the remaining 90. Someone takes that 90, spends it, and the shop owner deposits it in another bank. That bank keeps $9 and lends out 81. This cycle repeats. By the end, your original $100 has multiplied into nearly $1,000 circulating in the economy. But here's the critical point. Only the first $10 actually exists. The rest is debt. Every new dollar in the system is born as someone's debt, with interest. If this surprised you, here's the bad news. This is the old story. Today in the US, the reserve requirement isn't 10%. It's 0. Since March 2020, the Federal Reserve no longer requires banks to keep even a single dollar in reserve. So what keeps banks from lending infinitely? The brakes are no longer reserve requirements. They are capital and liquidity rules set under a global framework called Basel. Basel rules, especially after the 2008 crisis, were written by a group of central bankers and regulators meeting in Basel, Switzerland. These rules aren't written by Congress or Parliament, they're written by unelected technocrats. Here's how the system works. Banks must prove they have enough equity capital to cover the risky loans they make. For example, to issue a $100 risky loan, a bank might need $8 of its own capital as a buffer. That's the real limit. Banks must also prove they have enough liquid assets, cash, government bonds, things they can sell quickly, to survive short-term stress. These rules exist to prevent banks from taking excessive risk. But take note, banks no longer lend from deposits. They create the loan first, and the deposits appear afterward. When you take out a mortgage, the bank doesn't pull money from a vault. It types new money into your account. That money exists because you agreed to owe it. Then the bank checks whether it has enough capital to support it. In the modern system, more than 90% of the money in circulation doesn't come from the central bank, cash, reserves, or gold. It comes from credit created by banks. Think about it. The money you see in your bank account is not the same as money issued by the Federal Reserve. It's bank-created money, born as debt. That's why the money supply expands constantly, as long as banks keep issuing loans, and why every financial crisis is actually a crisis of confidence. When debts can't be repaid or banks can't roll them over, the system begins to crack. This design leads to three inevitable outcomes. Inflation. As the same dollars are multiplied, each unit becomes worth less. Perpetual debt. Since money is born as debt, the system always contains more debt than money. Concentration of power. Banks collect interest on money they never had. Governments quietly finance wars, bailouts, and programs. The wealthy grow richer as asset prices inflate, while workers lose purchasing power. When the machine stumbles, the illusion breaks. Look at the 19th century bank crises. Look at the Great Depression in 1929. Look at 2008. The mortgage bubble was the modern version of the same old trick. When defaults spread, the system almost collapsed. And once again, governments and central banks pumped in trillions to save the illusion. Because without it, the modern economy cannot function. On a global scale, the US has no reserve requirement. The UK, Canada, Australia, Europe, their reserve rules have long been symbolic. All are governed by Basel rules. Developing countries, China, India, Brazil, still have higher reserve ratios, sometimes over 10%, but even they sit under the Basel capital framework. It doesn't matter where you live. Money isn't created by deposits in a vault. It's created by rules written in Basel. And here's the uncomfortable truth. The system cannot afford for you to be debt-free. If everyone paid their debts today, the money supply would collapse. Banks couldn't lend. The economy would freeze. The illusion requires your participation, your borrowing, your spending, your belief that the numbers in your account are real. You are both the fuel and the collateral. This is why history matters. The medieval goldsmith's trick grew and grew until it became the foundation of modern finance, and the danger remained the same. 19th century bank panics, the 20th century Great Depression, the 21st century mortgage crash, all are echoes of the same story. Promises stretching beyond reality, and a public that trusts those promises. Every crisis reminds us that the illusion is fragile, and every time the solution is the same. Patch it, move on, forget. So what should you take from this? First, money is not wealth. Wealth isn't numbers on a screen. Wealth is land, resources, skills, knowledge, and independence. Things that hold value even when paper promises collapse. Second, debt is not neutral. It's the lifeblood of the system, and it's you who consumes more of it than anyone. Third, inflation isn't an accident. It is by design. You're asked to run faster every year just to stay in place. This isn't an apocalypse prediction, but it does mean you should rethink your relationship with money. Keeping cash in the bank won't protect you. Blind faith in the system won't make you free. Building real wealth, wealth that exists outside inflation and debt, is the only path. This lesson isn't paranoia, it's awareness. If your money is born as someone else's debt, your freedom depends on your ability to step outside the machine. History doesn't repeat, but it rhymes. Medieval goldsmiths, 19th century bank panics, the 2008 housing bubble, all variations of the same story. Promises multiplied beyond reality, and people who believe them. And the story isn't over. Every major financial crisis shows that the only true foundation under the system isn't gold or production, it's trust. And trust is the easiest thing to lose. Next time you look at your bank account, remember, most of that money exists only on paper, born from debt. Understand the trick, and you can protect yourself. Fail to understand it, and the house always wins. If this gave you a new perspective, subscribe. History already holds the answers, and I'll show you where to look. Until next time, thanks for being here.